Hey everyone, and welcome back to the Safe Simple Sound podcast, Tax Edition. I'm your host, Sam. Thanks for tuning in. Today, we're tackling a topic that pops up a lot, especially as more people explore side hustles and ways to generate extra cash flow, maybe even what some consider passive income. What are the tax rules when you start earning money from renting out your property? We're talking about your car, tools, equipment, that kind of thing, not necessarily big real estate ventures just yet. Our discussion today is grounded in the rental income tax basics as outlined by the IRS, specifically focusing on guidance related to personal property rental tax. We're aiming to simplify these fundamental concepts for you, drawing insights from how the IRS views this type of income, particularly as explained in resources like their Publication 17. And right off the bat, a couple of things are really crucial to understand from the official guidance. First, that income you earn from letting someone use your property? Generally, yes, the IRS wants to know about it. It's typically considered taxable income that you need to report to the IRS. Second, and this is where it gets really important for your bottom line, how you conduct that rental activity truly matters. Is it a formal business? Are you just aiming for profit on the side? Or is it more of a hobby? This rental income classification is key because it determines how and where you report the income, and very importantly, what rental income deductions you might be eligible to claim. Getting clarity on this is absolutely essential for embracing mastery of your cash flow and really understanding your financial choices. Knowing the tax implications helps you plan better and keep your finances sound, which is what we're all about here at Safe Simple Sound. It's a key part of seizing financial control. As always, we'll keep this discussion focused on clear, reliable information to help you navigate your finances safely and simply. Ready to demystify the basics of rental income tax for your personal property? Let's get started. I know is on a lot of your minds, especially with the rise of the sharing economy. You've got stuff, maybe a car you don't drive every day, some power tools sitting in the garage, even camera equipment, and you think, hey, maybe I could rent this out. Great idea. But then comes the big question, is your side gig taxable? Specifically, let's talk rental income fundamentals today. So you lend your neighbor your fancy lawnmower for the weekend and they slip you $20. Or maybe you list your car on a sharing app and make a few $100 over the summer. Does Uncle Sam care about that? Let's break down the rental income tax basics. First things first, we need to understand the IRS's starting point. Point number 1, defining taxable income. Here's the general rule, and it's pretty broad. The IRS considers all income, whether it's money, property, or services you receive, as taxable income unless there's a specific law that says it isn't. Think of it like an umbrella rule. If money or value comes your way, the default assumption is that it counts. Now let's get specific. Point number 2. What is rental income in this context? When we talk about rental income, we mean payments you receive for letting someone else use your property. Now, crucially for today's discussion, we're focusing mostly on what the IRS calls personal property. This isn't about renting out a house. We'll touch on that in a sec. This is about things like vehicles, tools, equipment, maybe even things like party supplies or specialized gear. Think about it. Maybe you rent out your truck occasionally. That's a common one. Or perhaps you have high-end photography equipment you rent to other enthusiasts. This is exactly the kind of personal property rental tax scenario covered in Part 2 of IRS Publication 17, which is a great resource for foundational tax info. This directly addresses the question of what types of personal property people might rent out. It could be almost anything you own that someone else might pay to use temporarily. So, you receive that payment for letting someone borrow your gear. What next? Point number 3. It's generally taxable. This is really important to grasp right from the start. That income you get from renting out your personal property? Yep, it's typically considered taxable rental income. This means you generally need to report rental income to the IRS on your U.S. tax return. And this is why it's crucial to understand, even if it feels like small amounts, that $20 here, $50 there, it adds up, and technically, under those IRS rental income rules, it's likely income you need to account for. It avoids surprises down the line. Now, a quick clarification. Point number 4. Personal versus real estate property. I mentioned we're focusing on personal property like cars and tools today. Renting out real estate, like a room in your house, a whole apartment, or a vacation home, definitely generates rental income too, and many of the principles overlap. However, the rules for real estate and vacation homes get much more detailed and complex. There are different considerations, different expense rules, and different IRS resources you'll need. For instance, IRS Publication 527 is the go-to guide for residential rental property. So just keep in mind, while we're covering the basics today, mainly through the lens of personal property, if you're dealing with renting out a place, you'll need to dive into those specific resources. So, let's quickly recap the key takeaways for today's rental income tax basics. The IRS generally views all income as taxable unless stated otherwise. Rental income includes payments for using your personal property. Think vehicles, equipment, tools. This personal property rental tax income is generally taxable and needs to be reported, even small amounts. Renting out real estate has its own, more complex set of rules found in separate IRS publications. Okay, feeling a bit clearer? Good. Now, here's a little homework for you. Your call to action for this segment. Take inventory. Grab a piece of paper, open a notes app, whatever works. List any instances in the past year where you received payment, cash, app transfer, whatever, for letting someone use your personal property. Did you rent out your car? Loan out tools for cash? Let someone use your recreational gear for a fee? Just make a list. This isn't about judging or calculating tax yet. It's purely about awareness. Recognizing where this type of income might be appearing in your life is the very first step. So, in our last segment, we dove into the fundamentals, establishing that yes, generally that extra cash you make from renting out your stuff, whether it's your car, some tools, or maybe even that fancy camera, is considered taxable rental income by the IRS. Knowing that is step one. But now we hit what I honestly think is the most critical factor right after that. How exactly do you classify that rental activity? This isn't just tax jargon, folks. Getting this right determines everything about how you report your income and, crucially, what expenses you're allowed to deduct. Now we're tackling topic 2, business, profit-seeking, or hobby. Classifying your rental activity. We're going to break down the 3 main ways the IRS looks at these activities, because trust me, it makes a huge difference come tax time. Okay, first up, let's talk about rental as a business. This classification applies when your primary motive, your main goal, is to make income or profit, and you're involved in the activity regularly and continuously. Think of someone who runs a small business, renting out audiovisual equipment full-time, or maybe manages several properties they rent out consistently as their primary source of income. They're actively marketing, maintaining inventory, keeping business hours. It looks and feels like a business. If this is you, your rental income and expenses generally land on Schedule C, the profit or loss from business form. Now, the second category is rental for profit, but not a business. This is a really common one for folks with side hustles involving personal property rental tax. Here, you definitely intend to make a profit. You're not just giving stuff away, but maybe your activity isn't quite regular or continuous enough to be considered a full-blown business. Think about it. Maybe you rent out your high-end drone a few weekends a month when you're not using it. You charge a fair market rate, you track your income, you want to make money from it. But it's not your main gig. You don't have a storefront, it doesn't consume your week. In this case, you're likely renting for profit, but not as a formal business. And where does this income go? Typically, you'll report rental income and related expenses on Schedule 1. We'll get into the specific lines in our next segment, but the key difference is the form used compared to a business. Then we have the third bucket, rental not for profit, often called a hobby. This is where the profit motive is essentially absent. Maybe you let your neighbor borrow your lawnmower occasionally and they give you $10 for gas and trouble, or you rent your canoe to a friend for a weekend for a nominal fee, more out of convenience or enjoyment than a real desire to make money. The primary driver isn't profit. Now, you still have to report that income, usually on Schedule 1 as well. However, and this is a big however, your ability to deduct expenses is severely limited. We'll unpack those limitations next time, but understanding this business versus hobby rental distinction is absolutely crucial because the deduction rules are night and day. So you see the direct link, right? Your classification, business, for profit, or hobby, directly impacts your tax reporting. It dictates which path you take on your tax return, essentially deciding between Schedule C versus Schedule 1 rental income reporting for profit-driven activities and placing significant restrictions if it's just a hobby. Think of it like choosing the right roadmap based on your destination. Picking the wrong one can lead you astray. This is a good moment to pause and reflect. Considering your own rental activities, or maybe ones you're planning, what factors point towards it being a business versus just an activity for profit, or perhaps even a hobby? What's your primary motivation? Is it truly to make a consistent profit? And think about that phrase, regular and continuous. How does that aspect help you differentiate? Is this something you actively manage and engage in frequently, or is it more sporadic, happening only now and then when the opportunity arises? These aren't always easy lines to draw, but thinking through them is essential. All right, let's quickly recap the key takeaway here. Classifying your rental activity as either a business, for profit but not a business, or not-for-profit hobby is foundational. It sets the stage for how you report income and what expenses you can potentially claim. So, your action item from this segment is this. Reflect honestly on your primary motivation and the level of activity for any rentals you have. Are you in it primarily for profit, and how regularly are you engaged? If you're unsure, especially about that sometimes tricky business versus hobby rental line, it's worth consulting the IRS resources. Just search IRS business versus hobby activity. They have guidance that can help clarify things. So, now that you've hopefully got a better handle on which category your rental gig falls into, let's tackle the next logical question. Okay, Sam, where do I actually put this information on my tax return? This is topic 3, show me the forms. Reporting income and claiming deductions. This is where the rubber meets the road, where we connect that classification directly to specific lines on your Form 1040 rental income reporting. First up, let's talk about rentals classified as a business. Remember, this typically means you're doing it regularly, continuously, with the main goal of making income or profit. If this sounds like you, maybe you run a small equipment rental operation out of your garage, then the IRS wants you to use Schedule C, profit or loss from business. It's pretty straightforward here. You report your gross rental income, and then you deduct your related business expenses directly on that same form. We're talking about those ordinary and necessary expenses directly tied to running that rental business. Things like maintenance, insurance, specifically for the rental items, maybe advertising costs. So, business equals Schedule C. Easy enough, right? Okay, but what if you're renting stuff out for profit, but it doesn't quite reach that business level? Maybe you rent out your really nice camera gear a few times a year to other photographers, definitely intending to make money, but it's not your main gig or super regular. This is where Schedule 1 comes into play. Specifically, you'll report that personal property rental tax income on line 8L of Schedule 1. And the good news? You can still deduct your related ordinary and necessary rental expenses. Those go into the total amount you enter on line 24B of Schedule 1. So profit seeking equals Schedule 1. Keep those receipts for cleaning, minor repairs, or listing fees. Now, for the third category, the nonprofit rental activity, or what many think of as a hobby rental income. Let's say you rent out your kayak just a couple of weekends a summer, mostly to offset your own costs or just because you're not using it. You still have to report rental income to the IRS. This income also goes on Schedule 1, but on a different line, line 8J. But here's the huge difference. Deductions are really limited. First, your rental income deductions cannot be more than the income you earned from that hobby rental. You can't claim a loss. Second, you can only claim these limited deductions if you itemize your deductions on Schedule A. If you take the standard deduction, you get no expense deduction for the hobby rental, even if you had legitimate expenses. So hobby equals Schedule 1 for income, but deductions are restricted, require itemizing on Schedule A, and can't create a loss. Big difference. This really highlights our next key point. The type and amount of rental income deductions you can claim are directly tied to how your activity is classified. Business on Schedule C usually allows the broadest range of deductions. Profit-seeking on Schedule 1 is still good for those ordinary and necessary expenses. Hobby activity? Very restricted. So thinking back to our questions, that person running the equipment rental business uses Schedule C and deducts expenses there. The person renting their car out occasionally for profit, but not as a business, would likely use Schedule 1. If they were just renting it to a friend once for gas money, it might be hobby territory. What are those ordinary and necessary expenses? Think cleaning fees between rentals, minor repairs needed because of the rental, insurance costs specifically allocated to the rental use, maybe platform or listing fees if you use an app. Again, how much and if you can deduct depends on that classification. And that brings me to the golden rule, the absolute non-negotiable, regardless of whether you're using Schedule C, Schedule 1, or dealing with hobby limits. Keep meticulous records. Seriously, I can't stress this enough. Accurate records of all your rental income and every single expense are essential. Why? To accurately report rental income to the IRS, to substantiate every deduction you claim if they ever ask, and frankly, to make sure you're not leaving money on the table by forgetting legitimate expenses, whether it's a simple spreadsheet, a dedicated app, or even just a very organized folder of receipts. Find a system that works for you and use it consistently. Trying to reconstruct this stuff months later is a nightmare. So let's recap Topic 3 quickly. We saw where the numbers go. Schedule C for business rentals, Schedule 1 for profit-seeking non-business rentals, and Schedule 1 for hobby income with those tricky deduction limits tied to Schedule A. We reinforced that your rental income classification directly impacts your allowable rental income deductions. And we hammered home the importance of record keeping. Okay, homework time. Here's your call to action. This week, I want you to head online to irs.gov and just pull up the instructions for Schedule C and Schedule 1. You don't need to become an expert overnight, but just familiarize yourself with the layout and what they ask for. Even better, start organizing your rental income and expense records now. Set up that spreadsheet, download an app, label that folder, whatever works. Getting organized today saves headaches tomorrow, trust me. In our last segment, we walked through the nuts and bolts of actually reporting your rental income and claiming deductions, figuring out whether you land on Schedule C, Schedule 1, or even have those hobby limitations affecting your Schedule A. We talked about the importance of meticulous records, which, trust me, is your best friend come tax time. Now, building on that, we need to address some important boundaries and special cases. Think of it like this. We've learned the basic rules of the road for renting out your personal property, but now we need to be aware of the speed limits, some tricky intersections, and when we might need a more detailed map or even a professional guide. That's what Topic 4, limits, special cases, and where to learn more is all about. We'll touch on crucial limitations, specific types of rentals that follow different rules, and point you towards the official resources for those deeper dives. First, let's quickly revisit those hobby rental income rules, or what the IRS calls activity not for profit. Remember how we discussed classifying your rental activity? If your renting falls into that hobby category, maybe you lend out specialized camping gear occasionally more for fun and to cover some costs, rather than as a serious profit-making venture, the rules for rental income deductions get really tight. Let's recap those key limitations on deductions for hobby rental income. 1. Your deductions cannot be more than the income you actually bring in from that hobby. No losses allowed. 2. You can only claim these limited deductions if you itemize deductions on Schedule A of your Form 1040 rental income reporting. If you take the standard deduction, you can't deduct those hobby expenses at all. And 3. You absolutely cannot use a loss from this hobby activity to reduce your other taxable income, like from your main job. You might wonder, why is the IRS so strict here? Well, fundamentally, the tax system is designed to tax profits and allow deductions for legitimate business or investment expenses. It's about fairness, preventing folks from essentially writing off personal expenses or hobbies against their primary income under the guise of a rental activity that isn't truly profit-driven. It ensures we're following the IRS rental income rules as intended. Okay, moving on. Another set of rules you might hear about are the passive activity limitations. Now, we're not going to dive deep into this today because, frankly, it can get complicated very quickly, especially when real estate gets involved. Think of this as a heads up. There are specific IRS rules that can limit your ability to deduct losses from certain passive activities, which can include some rental situations. It's a concept designed to prevent certain types of tax shelters. If you suspect this might apply to you, or you just want a passive income tax overview in detail, the definitive guide is IRS Publication 925, Passive Activity and At-Risk Rules. We're mentioning it so you know it exists, but for the detailed map, Pub 925 is your destination. This next point is crucial, folks. Everything we've focused on regarding rental income tax basics and personal property rental tax, like renting out your car, tools, or camera equipment, follows the rules we've discussed from IRS Publication 17. However, if you are renting out residential real estate, like a room in your house, an apartment you own, or especially a vacation home, you've entered a different ballpark with its own specific and detailed rule book. The rules around how many days you rent it versus use it personally, how you allocate expenses, what you can deduct, it's much more involved. So if you're listening and thinking, wait, I rent out a room on Airbnb, or I have a cabin I rent out sometimes, your immediate next step isn't just Publication 17. You need to go directly to IRS Publication 527, Residential Rental Property. Seriously, bookmark this one if real estate or vacation home rentals are part of your picture. That's where the specific guidance lives. And while we're pointing you to resources, if you're dealing with the specifics of property management expenses for real estate, or need broader information on small business tax considerations because your rental is a full-blown business, those details are also covered more thoroughly in Publication 527 and another handy guide, Publication 334, Tax Guide for Small Business. Think of these publications as the specialized manuals for those specific situations. So what's the big takeaway here? Understanding the fundamentals we've covered, especially the rental income classification and the basic reporting for personal property rentals, gives you a solid foundation. Knowing how to report rental income on Form 1040 Schedule 1 versus Schedule C is key for simple cases like renting equipment tax or renting vehicle tax. But just as important is recognizing when your situation might be more complex. Real estate, vacation homes, potential passive activity limitations, these are signals that you need to dig deeper. Don't try to apply the simpler personal property rules where they don't fit. Always refer to the specific IRS publications we mentioned. That's 527 for residential and vacation home rentals, 925 for passive activity rules, and 334 for general small business guidance. And remember, consulting with a qualified tax professional is often the wisest move when things get complex. They can help ensure you report rental income to the IRS correctly and take the rental income deductions you're entitled to without running afoul of the rules. All right, here's your action item for this segment. Take a moment to think about your specific rental situation. Does it involve real estate, a vacation home? Do you have losses that might bump up against those passive activity rules? If the answer is yes to any of these, your next step is clear. Go bookmark IRS Publications 527 and 925. Download them, skim the table of contents, and see what applies to you. And seriously consider if it's time to chat with a tax pro. Getting it right from the start is always simpler in the long run. Knowing where the lines are drawn and where to find more help is just as important as knowing the basic rules. Hopefully, this gives you a clearer map. All right, folks, that wraps up our discussion for today on the Safe, Simple, Sound podcast. We've navigated the essential rental income tax basics, focusing specifically on what happens when you're earning money from personal property rental tax. Think renting out your car, your tools, that kind of gear. We covered some really crucial ground. First, that yes, you generally need to report rental income to the IRS. But the biggest point, and I hope this really stuck, is the importance of classifying your rental activity. Is it a business, just for profit, or a hobby? Because that classification is the absolute key. It dictates how and where you report your income, particularly the Schedule C versus Schedule I rental income distinction, and it dramatically impacts the rental income deductions you're allowed to claim. We also touched on those specific limitations under the hobby rental income rules. Remember, deductions can't exceed income, and you can't claim a loss against other earnings if it's truly just a hobby. Getting this classification right is fundamental to managing your side hustle taxes correctly and confidently. It's a core part of seizing financial control and keeping your financial life safe, simple, and sound. As always, thank you so much for tuning in and spending your valuable time with me today. I truly appreciate you being part of the Safe, Simple, Sound community. Definitely check out the show notes for links to the IRS resources we talked about, like Publication 17 for the basics, and remember Publications 527 and 925 if your situation involves real estate or potential passive activity rules. If you found this episode helpful, please consider subscribing to the podcast so you won't miss what's coming up. And hey, leaving a quick review or sharing this episode with a friend who might be renting out their stuff really helps us reach more listeners like you. Next time, we'll be diving into another key area to help you build financial confidence. Until then, stay informed, stay proactive, and keep making those sound financial choices. This is Sam, signing off.